Did you know that with just $10,000 invested in the right place at the right time, you could accumulate $51 million over a lifetime? It may sound exaggerated, but this isn't some abstract idea or a false promise of quick riches. This is pure math confirmed by one of the greatest investors of all time, Warren Buffett. Buffett, the billionaire who began his journey with modest investments, often recalls one of the first lessons he learned, a lesson that came at a steep price and one he never forgot. At 11 years old, he bought 3 shares of City Service preferred stock for $38, $25 each. When the price dropped to $37, he nearly panicked but kept his composure. When the shares rose to $40, he quickly sold, thinking he made a good deal. He made a small profit, but not long after, those same shares skyrocketed to over $200 each. Buffett recalls, "This experience taught me 2 things. Patience is worth its weight in gold, and trying to guess the market's moves can be a disaster for your returns." In this video, we'll reveal how to follow Buffett's teachings to turn $10,000 into millions using simple strategies, practical examples, and, most importantly, patience. If you think investing is for experts or billionaires, get ready to completely change your perspective. What you're about to discover could change your financial future forever. Warren Buffett is known as the greatest investor of all time, amassing a fortune exceeding $100 billion through his company, Berkshire Hathaway. He transformed a small textile company into a global conglomerate, achieving average annual returns of around 20% between 1965 and 2022, more than double that of the S&P 500 during the same period. His success is attributed to patience, discipline, and focusing on the intrinsic value of companies. Buffett is famous for his strategic acquisitions of large companies and stakes in iconic firms. Some of Berkshire Hathaway's major investments include Apple, which makes up the largest portion of his portfolio, Coca-Cola, American Express, Bank of America, and Chevron. In addition, Berkshire fully owns companies such as Geico, Duracell, Dairy Queen, and the railroad network BNSF Railway. His investments reflect a long-term philosophy, betting on solid and predictable businesses. Buffett also stood out during crises such as in 2008 when he invested billions in companies like Goldman Sachs, seizing moments of pessimism to acquire valuable assets. His strategy, combined with an ethical sense and a focus on sustainable growth, made him a global reference in business and investing. Today, he shares a powerful message. True wealth doesn't come from hitting the right moment to buy or sell, but from investing for the long term and letting time work in your favor. So, why aren't you investing yet? Perhaps because you've never heard of the transformative power of compound interest, or maybe because the stock market feels like an unfamiliar and intimidating territory. But the truth is, if you're not investing, you're missing the chance to let your money work for you, just as Buffett learned to do. The simplicity of a good investment. Buffett teaches us that investing doesn't have to be complicated. He says, you don't have to be a rocket scientist. Investing is not a game where the guy with the IQ of 160 beats the guy with the IQ of 130. In one lecture, Buffett explained how an initial investment of $10,000 in 1942, applied in an index fund tracking the S&P 500, could have turned into an incredible $51 million over about 80 years. This doesn't require special skills or the gift of predicting the market. All you need is patience and the belief that the capitalist system will continue to work, allowing the largest companies to grow and prosper. What is the S&P 500? The S&P 500, Standard & Poor's 500, is a widely used stock market index that measures the performance of the 500 largest companies in the United States based on market capitalization. It was created by the financial analysis firm Standard & Poor's in 1957 and is considered one of the key indicators of the stock market, serving as a reflection of the overall health of the U.S. economy. The companies included in the S&P 500 are selected based on several criteria, including market capitalization. The company must have a market value of at least $8, $2 billion, as of 2021. Liquidity. The company's shares must be widely traded. Sector. The companies in the index must represent a diversity of economic sectors such as technology, health, energy, finance, and consumer goods. Financial history. The companies should have a stable earnings history and good corporate governance. The S&P 500 companies are weighted by market capitalization, meaning that companies with larger market values, such as Apple, Microsoft, and Amazon, have a greater impact on the index's performance. How the S&P 500 works: the index is made up of 500 of the largest companies, which makes it a fairly accurate representation of the U.S. stock market. The S&P 500 is used by investors and analysts to gauge the performance of the market as a whole, and it also serves as a basis for investment vehicles like mutual funds and index funds, ETFs, that aim to replicate the index's performance. The composition of the S&P 500 is regularly reviewed, with changes to the companies included based on their performance and evolution in the market. Every quarter, companies may be added or removed from the index based on market conditions. S&P 500's history over time. The S&P 500 has an impressive growth history, although it has also gone through some crises and periods of volatility. Below is a summary of the index's performance over the years, highlighting key historical milestones: 1950s, 1960s. The early years: 1957. The S&P 500 was created, and in its early years, the index reflected the post-World War II economic recovery. During the 1950s and 1960s, the United States experienced a period of robust economic growth. Initial growth. The S&P 500 performed well, with an average annual return of around 15% during the 1950s. 70s. Crises and stagflation. 1970s. The 1970s were marked by high inflation, oil price shocks, and a recession. The 1973 oil crisis and stagflation, high inflation combined with economic stagnation, hurt the U.S. economy. S&P 500. Performance. During this period, the S&P 500 had very low returns and, in some years, lost value. The index performed negatively in 1973 and 1974, and investors faced significant uncertainty. 1980s, recovery and growth. 80s. The 1980s marked the recovery of the U.S. economy after the previous decade's crisis. The Federal Reserve's monetary policies under Paul Volcker's leadership helped control inflation. S&P 500. Return. The index saw impressive growth, especially after the end of the 1982 recession. The average annual return was about 17% during this decade, fueled by technological innovations and the rise of major companies like Microsoft and Intel. 1990s. The technology era. 1990s. The 1990s was a time of significant economic growth and technological innovation in the U.S. The boom of tech companies led to a strong appreciation in the stock market. S&P 500 performance. The index saw spectacular growth, with annual returns exceeding 18% on average. The dot-com bubble that formed at the end of the decade had a significant impact, though it burst in 2000. 2000-2009. The dot-com bubble and global financial crisis. 2000-2002. The dot-com bubble burst, and many technology companies lost a significant portion of their value. During this period, the S&P 500 faced substantial losses, with the index showing negative returns of around 1% per year from 2000 to 2002, then 2008-2009. The global financial crisis of 2008 had a devastating impact on many markets, with the S&P 500 falling more than 50% during this period. The bankruptcy of Lehman Brothers and the collapse of the global financial system led to a major recession. Recovery. Although the market faced severe challenges, the S&P 500 began to recover quickly after the 2008 crisis, thanks to aggressive monetary policies from the Federal Reserve. 10. Present. Post-crisis recovery and growth 2010s. After recovering from 2008, the S&P 500 experienced a period of steady growth, driven by global economic recovery, the growth of tech giants like Apple, Amazon, and Google, and more relaxed monetary policies. 2020 and the COVID-19 pandemic. The COVID-19 pandemic caused a global economic slowdown in 2020, but stock markets quickly recovered due to fiscal and monetary stimulus policies, as well as technological innovations. Recent performance, the index, has continued to show strong returns, with technology growth leading the market. In recent years, the S&P 500 has seen an average return of around 10 to 15% annually, reflecting the continued growth of the U.S. economy and global markets. Historical return of the S&P 500. The performance of the S&P 500 over time can be better understood through the following historical average annual return data, considering reinvested dividends. 57, 2022. The S&P 500 has had an average annual return of about 10% throughout its history, meaning that investors who kept their investments long-term experienced significant growth in their capital. High-performance periods. During the 1980s and 1990s, the index had exceptional returns, with annual averages of 17 to 18%. Low-performance periods. During periods of crisis, such as the dot-com bubble and the 2008 financial crisis, the S&P 500 went through steep declines, but with a rapid recovery over the long term. The S&P 500 is one of the most reliable and representative stock indices in the United States, and it offers a great option for investors seeking diversified exposure to the stock market. Although the index goes through periods of volatility, its long-term performance has shown consistent growth, driven by technological innovations, the growth of the largest U.S. companies, and the strength of the capitalist system. Investing in the S&P 500, whether directly or through index funds, has been one of the most successful wealth-building strategies over time, thanks to the power of compound interest and the growth of companies. Had you invested $10,000 in the S&P 500 in 1942 and left the money there, your return would have been extraordinary. This is the power of compound interest in action. On average, the U.S. stock market has returned about 10% per year. With reinvestments and accumulated growth, this is how small amounts can grow exponentially. Buffett illustrates this with a powerful analogy. Investing in stocks is like planting a tree. You plant it today, take care of it over the years, and eventually, you'll reap the fruits. The secret is not to chop the tree down before it's ready. The cost of wrong choices. To highlight the importance of investing in productive assets, Buffett makes an interesting comparison between the stock market and gold. He explains, if you had used the same $10,000 to buy gold in 1942, today it would be worth around $400,000. It sounds like a lot, but that's nothing compared to the $51 million you would have with the S&P 500. Why this difference? Gold, while valuable, is not a productive asset. It doesn't generate dividends or create additional value. Gold remains the same while companies like Apple, Microsoft, and Coca-Cola grow, innovate, and expand their profits. Buffett sums up this idea with a clear phrase. With gold, you're staring at something that does nothing for you. With stocks, you're investing in companies that work for you day and night. Patience. The investor's greatest ally, one of Buffett's most important lessons, is about patience. He explains that many investors fail because they try to guess the right time to enter and exit the market instead of simply holding their investments over time. The market is like a roller coaster. It goes up and down. But if you look at the long-term chart, the movement is always upwards. For Buffett, investing is a long-term game. He believes the best investors are those who understand the value of time and avoid making impulsive decisions. He compares stocks to properties. Buying stocks is like buying a farm. You buy it not because of what it's worth today or tomorrow, but for what it can produce over decades. This philosophy led him to adopt the buy and hold strategy, where you invest in good companies or index funds and simply hold those positions for decades, regardless of market fluctuations. The dangers of trying to predict the market. Buffett also warns against the desire to predict market movements. He explains, "The headlines of today are irrelevant to long-term returns. The market is an efficient machine in the long run, but it can be an emotional machine in the short run." He recommends ignoring the daily noise and focusing on the bigger picture. Buffett emphasizes that trying to predict market cycles can lead to unnecessary losses and prevents investors from reaping the benefits of compound interest. Tangible examples of growth. If we assume an average return of 10% per year in the stock market, here's how an initial investment of $10,000 would grow over time. In 10 years, about $25,937. In 20 years, about $67,275. In 40 years, over $452,593. In 80 years, over $51 million. This all happens without adding another penny, just reinvesting profits and dividends. Buffett's message is clear. Invest simply, trust in the growth of companies over time, and be patient. He reminds us that you don't need to be an expert to become a successful investor. If you believe in the future and act with discipline, time will be your greatest ally. The secret, according to Buffett, isn't in timing the market, but in being in the market and staying there. After all, the true power of investing is in time. If this text inspired you to start your investment journey, remember Buffett's words. The best time to plant a tree was 20 years ago. The second best time is now. Like the video? Please subscribe to the channel to gain access to lessons from the most influential men and women in the fields of finance and personal development.